My name is Dennis Graves. Today I'd like to talk to you about the reality that investment portfolios and equity markets don't rise in a straight line. I'm sure you can remember the unsettling period of time in the fall of 2008 when we saw stock markets around the world dive and your portfolio right along with it. What I'd like to do though is address what types of things you might do to take advantage of or lessen the blow of events like this. Today I'm going to specifically talk about some tax planning ideas. Let's say, for example, that did happen to you in 2008, but perhaps, like many of my clients, you've forgotten that in 2005, 2006, 2007, we saw rising equity markets, particularly the Canadian market rose dramatically as a result of rising prices of nickel, copper, zinc, oil, gold. Those things very positively affected your portfolio. And thus the wealth effect kicked in, and clients were jubilant with the fact that they'd seen the rise in their wealth and decided to take some of that money and buy things like cars and condominiums and cottages. But as a result of those purchases, they extracted money from their non-registered portfolio, which attracts capital gain tax. Let me explain how that works. So I want to think of a particular scenario, a particular client in general, although this was something that happened sort of right across the board at varying degrees. Thinking of one client who had a taxable capital gains during those 3 years of $100,000. Well, that taxable capital gain attracted tax of $50,000. That's $50,000 that they had to pay rate to Revenue Canada. Well, when 2008 rolled around and they had experienced the decline in the value of their portfolio, we noticed that on a number of their investments, if we added them up, we noticed that there was a total decline of $100,000, that by moving them from another investment, but from that investment, let's say a mutual fund or an individual stock, I'll use an individual stock example. Let's say they saw that loss on Royal Bank shares. So the Royal Bank shares that they had bought had declined dramatically. We said, well, let's trigger that loss by moving the Royal Bank holdings, selling the Royal Bank stocks, buying TD. So we kind of moved sideways because both had declined by similar amounts. That created the taxable capital loss that we were then able to refile their tax returns from 05, 06, and 07 and apply those losses experienced in 08 to those tax returns against the gains experienced at that time. That created a tax refund for them in early 2009 of approximately $50,000. That $50,000 was then available to reinvest back into their portfolio at lower levels on the equity markets, which really helped to lessen the blow as their portfolios began to appreciate in 09 and 010 and 11. So that's an idea that perhaps demonstrates the importance of active management during difficult times. Thanks for listening.